Hello.
Hey, Mike, how are you?
I'm doing well.
Give me 1 second. Let me figure out my audio.
Yeah, you're sounding a little tinny.
Okay, can you hear me?
I can hear you just fine. Yeah.
Okay, good.
So, you got all your digits from the.
Yeah, I told that to my coffee barista this morning. I'm like, it was a good fourth. I got on my fingers.
Yeah. Right. Um,
You got to love a holiday that combines excessive drinking and explosives, right?
I know it's fascinating. I mean, when you really think about just utter destruction, is all you're doing is destroying money, shooting it in the air and going
Yeah,
ooh ah.
yeah. Well, it sounded like a war zone here last night. It was constant barrage from about dusk until I went to bed. I mean, thank God for air conditioning and windows closed because it was unrelenting.
We were up at a friend's lake house and a thunderstorm rolled through, and then all of a sudden, the thunder just kept happening and the storm was gone.
Yeah,
We're like, what's going on?
yeah, it's legal to buy and legal to shoot off in Ohio now. So game on.
Yeah, pretty much. So obviously we got some pretty big news here today.
Yeah, timing couldn't have been more perfect. Let me share my screen. Yeah, lots of activity all around. But obviously, the big news. We'll just jump right into it.
All right. Well, it is. A little bit afternoon. I think everyone's moving a little slow today. I know. I
Yeah,
for
yeah.
sure am. Uh, yeah. I woke up an hour and a half from my house, so the first thing I had to do was get home this morning.
Oh boy, yeah, that's always a fun thing.
Um, yeah. I just want to see the crowd on LinkedIn and go view as a member. All right. There's our smiling faces. 14 people. All right, yeah, we got enough here. Let's I think we should kick this thing off. Hello everyone. Welcome to Lumber from the Free Seats. Mike Wisniewski here with Greg Kuda, Westline Capital. And
Hello, hello.
we I found an email in my inbox this morning from the CME Group. And what has been anticipated for quite a while has finally come to an announcement on August 8th. The new lumber futures contract will launch. And, why don't I'm going to just share the screen here, get everybody out of the way. If you want more information, we'll talk about it here. But the CME on their website, I'm sure if you just look up lumber, has a pretty good um, update on what's going on. Greg, what did you think? What anything jump out at you?
No, I mean it's pretty much everything we had anticipated. Um, you know, so this is kind of the meat and potatoes of what they're doing. The the actuality, the minute details won't be announced. So everybody's aware. What you see is what we can kind of divulge. The remainder of it will officially be put out when they update the rule book, and that's 10 days, somewhere approximately 10 days before the actual trading, where the next step for this is to submit this to the CFTC. They need to get regulatory approval. That takes about 10 days. Thereafter, they'll actually put out the new rule book chapter. I think it's chapter 63, and that'll have every possible detail in that rule book. But until that point, what you see in writing is what we know. Everything else is speculation as far as what we think versus what we know. You have to see it in writing. But you can see what Mike is showing right now. There's a laundry list of questions that they answer. And again, that's kind of what we can divulge right now. above and beyond that, you're going to have to wait for the rule book rollout, which will be probably 10 days before the contract kicks off or thereabouts.
This Q&A is really, or good, frequently asked questions, I should say. It's really
Yeah,
good.
it's good.
The big deal is the size of the contract is going to be a truckload, 27,000 board feet, 27.5 is going to be the multiplier. But I thought this was kind of an interesting move too. They've changed the tick size. So the smallest increment that it'll move is 50 cents per thousand.
Right. And so that's twofold. They have to do it to where it kind of meshes up with, think about the existing contract. If you left it at 10 cents, you would have significant divergence versus the 50-cent increment. So that's first and foremost. They want to try to get it to match up to the big contract. And then the other big thing is the CME. And again, this is my understanding. They are going to pay market makers when the new contract rolls out. And from a market maker standpoint, market makers did not want the 10-cent increment. They wanted the 50-cent increment. So that's bringing in more potential from a market making capacity to have people that will make markets when this contract rolls out.
Right. And the reasoning behind the market makers wanting a bigger tick size is if you actually have a winning trade, you buy it and then sell it higher, one tick higher, and you make $2.75. That doesn't even cover the cost of the commissions.
Yeah, absolutely. So it's just a common sense approach, again, which is good. And then just so everybody is aware, and it clearly states this, you're basically going to have an exchange traded spread that converts one existing contract into the new contract. But if you're going to just trade the initial contract, the new contract, you can trade in increments of one. You don't have to trade 4 minis. You can trade a 27,500 contract. So, but the conversion of an existing contract into the new contract will be 1 to 4. For every one existing contract, it'll equate to 4 new contracts. And then you can see in number 7 there, and I think this is critical here.
Let's jump back to how you can transfer your legacy contract to the new contract. And through the spread, what we have to remember, and this is another kind of important thing to note, the new contract is priced delivered to the Chicago switching district. The old contract was priced loaded rail car in Prince George, British Columbia. So theoretically, the spread between the new contract and the old contract should be nothing more than the rail freight from Prince George, British Columbia to Chicago. And it's priced the new contract less the old contract. So what you're going to see is it's probably going to be around, the spread's going to be trading around $80 to $100. Is that, I don't even know, what is the
Yeah. I mean, again, I think the old rule of thumb was 85, but with freight, surcharges, fuel surcharges, 92, 95, it just, the market's going to, so here's the thing, the market's going to figure it out pretty quickly, what it thinks should be fair market value in deriving this spread. FOB Prince George, FOB Chicago, the market's going to figure out what it think, that differential should be. But yeah, again, somewhere in that probably 87 to 95, but we'll know that when this thing kicks off.
Right. So how the spread will work for you, if you have one long legacy futures, you go to this spread market. If you buy the spread, what you're going to be buying is you buy 4 of the new contracts, you sell 1 legacy. So you go from long 1 legacy, you sell it, you're flat there, you're long 4 new contracts. And if you're short a legacy contract, you sell the spread. And what that does is it sells 4 new contracts for you and it buys 1 old contract. The mechanism essentially rolls you out of the legacy contract and into the new contract.
Yeah, and so, again, you don't have a legacy contract. You can, start initiating positions in the new contract. You're going to have exchange traded spreads, so you could start trading. Realistically, you're not going to trade September. Well, maybe I guess August 8th, you'd still trade September. But if I wanted to do one September mini, I can do one September mini. If I wanted to do a Sept-Nov mini spread, I can do one Sept-Nov mini spread. Again, that's a quarter of the existing legacy contract. Um, Again, from a margining standpoint, the assumption is it's going to be a quarter of the size, but until the CME actually publishes that margin data, that's a completely different silo than the marketing arm, Allison Candace, Tom Crane's arm. So we have to wait and see, when margining, and that'll come out closer to the contract launch. We'll know the actual contract margining per mini contract. But again, what is in writing, this is what we know right now.
Right. And this, well, here's one thing we know as well. This, they have delisted any of the lumber futures contracts that had no open interest in them, were delisted as of today.
Yeah, so you can no longer trade beyond May of 2023. So May expiration of 2023, the existing contract officially is sunset and goes away. So that's the critical part is, you're going to have side-by-side contracts through May of 2023 expiration, but thereafter the existing contract is gone. And,
Right.
and I
And
think
then,
that's a critical component to make the new contract successful. That this is a sunset. The existing legacy contract is going to be sunset out of existence.
yep. And as the open interest declines on a particular expiration, and when it goes to zero, they'll sunset it.
Yeah, and I know somebody's asking, if either Mike can email the link or just contact us, and we'll be more than happy to send out the link to the CME. And Mike, I think you on LinkedIn, you can also find. I put something out this morning. I think MX liked it, so you'll be able to see it on LinkedIn as well, as far as the direct link to this.
Yeah. What I would do is just go to the search right here, the search icon, and just type in lumber right here. You'll find it. So, all right, let me get rid of that one. No, I don't want to I want to go back. All right, the next really big important thing is price limits. It's a whole new mechanism for setting the limit.
And so everybody is aware the changes that will take effect. So these price limits in the new contract will be implemented into the legacy of the existing contract. You're not going to have one market that has $49 limits and then another market that has 5% limits. There's going to be the spillover where they equate to each other. So, the rationale behind this price band or the circuit breaker limit is that, the vast majority of commodities that trade at the CME trade under these circuit breakers. And the idea is that it's more reflective. The existing limits that we have in lumber are always backward looking. So they're always a reflection of the past instead of what exists today. So the idea of the circuit breaker is that, whether it's going to be 5% or 7%, whatever they ultimately decide on, it's going to be based upon that underlying notional value that day. So if you're trading at $1,000, 5% of 1,000. If you're trading at 500, 5% of 500, so on and so forth, to where it's much more reflective of what that market is worth today. And that's kind of the CME has a website that tells you what the price limits are. So you can literally go on the CME and everybody, well, we can't figure out the limits. No, they publish this every single day. At the end of the day, they'll tell you based upon a 5% limit what the next day's trading limit is. And so, the other part of this thought process is that if people don't know off the top of their head what the limits are, markets rarely trade at these limits. So all these markets that have circuit breakers rarely, if ever, have limit up, limit down type moves where, at the end of the day, who cares what it's just based upon the underlying contract value.
Right. So the actual limit's 10%, but their
Yeah, I'm sorry,
circuit
there it is. Yeah.
breaker, the circuit breaker works if the market moves 5% of the previous day in a 60-minute window. Then a circuit breaker, a 2-minute pause in trading will occur. So let's say on the 61st minute, we go more than 5% of where we traded 61 minutes before, that circuit breaker wouldn't go into effect.
Yeah. And then the other thing, Mike, I want to stress is that, we all like to get hung up on daily price limits and limit up, limit down, market stopping to trade. Well, the last time I checked, there's no limits in physical cash. So futures
No.
should be able to reflect fair market value. You might not agree with fair market value, but you should be able to float and trade without artificially stopping. And that's the whole idea of the circuit breaker effect, that, look, if a market's meant to go to a price, then you're going to be able to float there a lot faster and start trading.
And this is some other stuff about block trading, which I think is going to come into play more with the smaller contract size. But we'll cover that at a later date. I don't want to.
Yeah, and so the only other thing I wanted to mention here, there's slight changes to last day to EFP. We'll cross that bridge once the rule book is out, and get into specifics of what they're trying to accomplish. But the reality is you're going to have a tender period to see who's on the other side. And the whole basis for doing this is this contract is no longer just a Western SPF contract. It's going to be an SPF contract. So Eastern and Western SPF. It's going to be Doug fir, fir larch, and hem fir. So anything with the number 2 stamp on it can theoretically be delivered at this point. And that's the huge difference, is it's no longer can be used by Western SPF mills without using it. You're going to have inclusion of Eastern SPF mills and domestic mills that physically can deliver into this. So the mechanics of how you would go through the delivery process, how you would EFP post expiration are going to be changed, but we'll cross that bridge when more specifics are announced, and that's all going to be when that rule book is announced. We can get in great detail. We can go into how EFPing and delivery mechanisms are going to work.
Yep, for sure. People keep asking where to find the frequently asked questions, and it is when you go to lumber, it'll bring you to this page, and then where did I find that? Maybe it was in. Right here.
Oh, right there. Yeah.
So yeah, off to the side under resources, it has frequently asked questions.
Yeah, so it's an exciting day, and that it's been a long road coming, but we're finally at that point where, to get to this point where they're publicly announcing this, means that the CME has gotten internal approval, and now you just have the formality of getting CFTC approval. And when you get to this point where they're publicly releasing this information, that's just a formality.
All right, and I just put it in the chat.
Yeah, perfect.
Frequently asked questions. All right, so I'm very excited that this is happening, and I'm going to shut mine off and let's get to the markets.
Yeah, so a lot going on. We'll jump right in here, start big, and then funnel into lumber. The big thing today is you have risk off just about everywhere, and lumber got lumped into this, where September traded limit up on Friday. Weekend takes place. Crude oil's down about 8.5%, 9% so far today. So lumber actually opened lower, and at one point September spiked limit down today. And so when you look at, we look at this aggregate composition of the different markets, the two things that jump out here is crude oil took out its lows from the last week and a half. You have demand fears overpowering any type of supply constraint issues, and then the other big thing is the 10-year interest rates from their highs a week and a half, 2 weeks ago, are off pretty substantially. The high water mark in the 10-year was about a 3.49 as of this morning. It was somewhere in this 2.89 to 2.82 area. So the markets in general are pricing in realistic recessionary fears right now. And it's pricing it in a lot sooner where, oh, maybe we could go into a recession Q1 of 2023. When you look at the different markets, all markets are really getting hit hard today with the idea that a recession could take place a lot sooner. When you try to put a timeline on it now, recessionary fears are very realistic into Q4 right now. So when you jump into here's 1-day returns, this is pretty amazing. Gasoline, crude oil, soybeans, corn, wheat, lumber, everything is just commodity complex as a whole today is just getting taken to the woodshed. Even gold, your supposed flight to quality is down today. And when you look at 1 month returns, you obviously have equities here, but just look at all the commodities. You've had a rolling over, a topping of commodities as a whole, and whatever inflationary expectations or fears were out there are getting overpowered right now by the idea of demand destruction. A recession is imminent, not just in the U.S. but globally. Recession fears are pretty much in every westernized market right now.
It is amazing. I mean, it is across the entire globe.
Yeah, no, it's and so this is the big picture year to date. So let's energy complex year to date. I think this was as of last Thursday, so this isn't real time, but you could see from a commodity standpoint, you still have massive positive gains in the energy complex, in soybeans and wheat, and low man on the totem pole. And again, this is lumber has rallied in the last 2 weeks, but lumber is still the leading indicator to the downside. You obviously have the equities down here. The one that kind of stands out to me is gold. How gold, and I'll kind of, this is another way of looking at it. And this is as of March of 2022. I tried to find the end of second quarter, but it's going to be, the only respite here, the only relief has been in commodities. Everything else from an investment standpoint has really been a massive disappointment. The idea of where do you put your money? Well, I mean, outside of cash, everything has really gotten beaten up here since the beginning of the year.
That is, that's there's no doubt cash would be the only thing you'd want. And actually, the dollar is strong. We're on our way to parity with euro.
So I'll come back to this. This is sector performance, but we'll jump back to this. But the one that's the most perplexing to me is gold, where typically that's your flight to quality commodity, and it's tough to rationalize why gold really isn't seeing any flight to quality here. And when you compare it to the mini S&P, it's tracking more with the mini S&P, which is highly unusual. Usually you have an inverse relationship with equities and gold. And the one thing that you just kind of referenced, Mike, that stands out is the dollar. You continue, this blue line here is the US dollar, and the whole idea of a strengthening dollar makes commodities more expensive, less attractive. And so the appreciation of the dollar is definitely having a significant impact on commodity price appreciation, where strengthening dollar is definitely seeing that flight out of commodities, outside of alternative investments. And so when you jump back now, We've looked at this is from Yardini Research. It was phenomenal, but this is year-to-date performance of the different S&P sectors, and you still have the obvious ones like energies, fertilizers, ag products have a positive rate of return year-to-date. And then when you look at the bottom of the barrel here, um, here's our home furnishings, home improvement retail, household appliances, building materials, building products, and then home building. So, obviously, higher rates have had a profound impact, negative impact on our industry, and it's referenced in the year-to-date returns here. And this is as of the end of June, so this is real time. And so when you go to, this is another great way of looking at the major investment sectors. The only kind of one that's got a positive rate of return here is energies. Everything else is just, if you're lucky, you're break even, you're off to, where some of these lower end ones are off dramatically here. And again, this is beginning of the year, which is just amazing to see this visually here.
It is. All right, what's happening in Lumberland? Oh, there's Bitcoin.
Yeah, here's this is the other one, and I did think this, and wrongfully so, that Bitcoin would be some kind of inflationary play, but obviously as inflation has risen, just the inverse, where Bitcoin is, again, just gotten annihilated here. So much for that theory. And so the only thing, when you look at kind of copper led the charge, lumber led the charge to the downside here initially, and you started to see this rolling over of other commodities. The one thing that stands out, this is China's stock price, stock indice, and you can see how you've had the weakening, the shutdowns, obviously have had a profound impact on their economy as far as consumption. So I think this goes a long way. We know that our equity markets have been weak, global equity markets have been weak, but China has been just as weak, if not weaker, because of their zero tolerance COVID policies. So this has had a profound impact on commodity consumption as a whole, and definitely a good explanation as to why demand, more so than the actual fear of demand slackening, the actual demand coming off in China has had a pretty profound impact on commodities year to date here.
I think when I look at inflation, one of the things I always think about is we import deflationary forces, meaning we get our goods wherever they come at the lowest cost. So China was our deflationary hedge almost. It's what kept prices in check. China went into this shutdown and we just couldn't get the goods that we wanted from China. So I think the Chinese shutdowns may have added to our inflation push. It definitely was a tailwind. But as they come back online, I think it's going to have somewhat of a deflationary aspect to it.
No, I think that's a phenomenal point, Mike. I absolutely 100% agree in that. And you have to wonder geopolitically, their zero tolerance policy, how much of that was really concern with their population and dealing with COVID versus teaching global economies a lesson that without China, look what inflation did. Look at all the supply chain snafus, issues, where you have to wonder how much of this was done by design to teach the Europe and the U.S. a lesson here.
That's a good question. All right, lumber.
So
hit the notes.
yeah, lumber. Here's so we'll just 30 years. So you can see the 30-year is off here from its recent high, and then we'll jump into lumber. Weekly continuation. We've definitely bottomed, but bottomed to do what now? This is this is the weekly continuation. So the market made a low in the 517, 518 area. You've had a pretty impressive rally where July did get up into the 670, 680 area on Friday before its free fall back to reality today. We're 630 last. So you've had that convergence between July and physical cash. When we jump forward, here's the July chart. Again, you've had a nice bottom off the lows, maybe a 50, 62% rally in July. would take you back to this 700 to 7.25 area. Realistically, if you flip the script into September here, you're more likely to get that 62% retracement in September. But to me, it's the hope at higher strategy, where how much has fundamentally changed. We probably got too overcooked, too overdone to the downside. So we've had a nice seasonal relief rally here, but a relief rally to do what? Remains to be seen. Where again, seasonally, we've bottomed a little bit ahead. And again, this is as of June 24th. Sorry, I couldn't update this. But we're basically into this time frame here where we would typically seasonally bottom. So the market is seasonally bottoming. Bottoming to do what? In that, I still think with all the headwinds out there facing housing, facing both forestry and the building sectors, to sustain higher prices, it's going to be less a function of demand. It's going to be more a function of supply constraints in the form of shutdowns or some type of, things that we can't control, like forest fires, that kind of stuff. But again, I'm going to beat this one into the ground. The idea of demand being the savior for higher prices in lumber is very questionable, to say the least. It's going to have to be more supply constraint driven to support higher prices in lumber right now.
And I mean, I look at that chart and, we could say, oh yeah, we bottomed, but doesn't mean we have to go racing higher.
Yeah. Yep.
And you see the average 5-year average, the bottom is in August.
Yeah.
So that's
the real bottom is in that August time frame, but then the real lows are still ahead of us into October. So if maybe we grind higher, go sideways, but if we're going to follow the seasonal pattern, then the real lows are still ahead of us into October, November.
Yep.
And so July SEP, you've had phenomenal volatility in these spreads. They've been truly phenomenal opportunities to trade these. We talked about the funds, and I'm going to jump forward here, Mike, and I'll come back. But CFTC numbers, managed money. I think we've stressed over the last 3 weeks how this is the segment to watch. And as of the last CFTC report, they're still adding to their position. So they've taken this massive position. And going back to the spreads, we talked about going into month end, how they would begin to roll their position out of July into September. And in doing this, they'd be buying back their July shorts and selling September. So amazingly, they took this spread from 25 under to, at the high water mark, we peaked out in the 45 to 50 over area. And literally the day they stopped rolling, and you can see it here, I think this was last Thursday.
Yep.
Let's see here. Yeah, last Thursday, they stopped rolling mid-morning, and this spread literally collapsed in from 45 over into the 10 over area, and has traded today. We've traded as narrow. We've traded in a range today of 2760 over to 2290 under. So the second the funds stopped their rolls, finished their rolls, you had a profound impact on the collapsing of the spread. And when you look at Sept-Nov, same exact thing. We talked about, okay, the funds are going to be selling September. So this kept this Sept-Nov spread suppressed. It was at 20 under, 14 under, 15 under. Literally that Thursday that they stopped rolling their position. And you could see this on an intraday chart. This spread went from the negative 14 area back to even money. And at its high water mark on Friday, traded 17 over.
So, something about that, I kind of want to call it the insider information or the pro move.
Yeah.
The funds will not trade a no limit contract. So they exit their July positions going into the end of June, going into the end of the month. They just don't want to get caught in a contract that has no limit on it.
Well, not only that, it's clearly spelled out when you trade with the commodity fund. If they're registered as a commodity fund with the CFTC, the NFA, they put out a prospectus. So just like any other publicly traded investment opportunity, they have to tell you specifically what they're trading or the methodology behind their trading. And a lot of these publicly offered prospectus, they'll tell you that we won't be in a we won't be in a deliverable contract month on this date. And certain funds like the Rogers Fund will roll a month in advance. Other funds will roll literally right before you get into that spot month. And so the beauty of this kind of spread trading, again, going back to CFTC numbers, to me, this adds a lot of predictability to trading lumber from a spread standpoint,
And
knowing that
I
they
think
have this massive position
let's
and knowing
just
that
define when we're saying roll, all we're saying is
yeah,
they need to exit their position in July and reestablish that position in September. And they do it simultaneously through the spread market. So if they are short July, what they have to do is buy July and sell a September. The action of buying July, selling Sep is what drove the July Sep's spread higher. So we use the term roll, and all it means is making a trade in the spread market to move their position from the expiring contract of July into September.
yeah, and just so people understand that when you go back a slide here, so when you look at this total open interest and you look at the breakdown, obviously July is a liquidating contract. A big chunk of this remaining open interest will conceivably be EFP'd, exchanged for physical, where they'll offset the July position with physical cash now. But when you look at the open interest in September at 1640 versus the open interest in November 304, 100%, 95%, 90% of the commodity fund open interest, 95% of the commodity fund position is going to be in the most liquid month. So it got moved out of July into this September position. And as long as they're going to maintain this position, at some point that September position gets moved into November. And so, you know, the big thing in trying to analyze and kind of forecast what the funds are doing here is obviously, or at least maybe it's at least to me, this is the obvious explanation is they want negative housing exposure. They think that housing has topped. They think that you want to be short somehow, some way. So you get short REITs, you get short some kind of inverse ETF that has a negative relationship to housing. But the big thing is that they want a negative exposure to lumber. So that's why they're going to maintain their short position. And how, so how would this change? Well, the market rallies to some kind of technical point, or there's some kind of fundamental change where they would liquidate this position. But without them liquidating the position, again, this adds by virtue of having the funds in the market, it adds a lot of continuity, especially to the spread trading of lumber futures here, knowing that they have to move their position at some point in time out of September and into the next contract.
Yep, that's that's the predictability that you can actually find through good analysis.
So we'll come back. I know we're bumping up against it, but we'll just quickly, from a basis standpoint, and again, this is as of I think as of last Thursday. I didn't have a chance to update them, but you see, and this was this doesn't reflect. We had a big 2 days up here, Thursday and Friday, before the give back today. So these really aren't overly accurate. Basically, you have cash somewhere in the 630. This negative, you're basically on par with September in physical cash right now. Same thing with July. July is 630, September 641. I think Fraser today was in the 630 to 640 area on 2x4. And most other mills are probably have raised their pricing up now to reflect that 6.25 to 640 area on Western S 2x4s.
Yeah, but I think, there's some specific items that might be laggards that
Sure,
you
sure.
could basis trade, buy, get long cash and short futures. And ironically, there's other items that you can forward price and be just fine as well.
Yeah. So and again, I think, Mike, this always goes back to have a plan and understand what you're doing. Where, what are the basket of goods you trade, and how do those historic, relate not only to futures but the other species. Where Southern Yellow Pine continues to be the leader to the downside, and then you stair step up from there. But understand what you trade when you need it, and again, look, the market's bottomed for the time being, but bottom to do what? And that just because it's done going down doesn't necessarily mean it has to go higher. In order to go higher, I think you're going to need to see more mill shutdowns. You're going to have to see supply disruptions versus I don't see that scenario right now. And I know, some of the guests later this week will have much more detailed cash information. But from a risk standpoint, when you look all around, you look at the energy markets, you look at commodities, you look at equities, it's risk off. So the idea that people see enough value in building out lumber inventory, I think it's going to be that mindset of just in time and kick the can down the road. And if we have to chase, then so be it. But I don't see this big inventory build with everything else going on, out there right now, to where higher prices are probably going to be a function of the supply side doing something about it more so than demand just blindly chasing this market.
Yeah, I think the demand destruction is built in at this point for sure. Um, I don't know how much destruction there really was. I think we're still going to be just fine, but it's really on the supply side that could make the market move at this point.
Yeah. Yep.
Our headwinds are things are more expensive. Everything's inflated. Interest rates are higher. It costs you more to own a home, so that's a major headwind for new construction. Um,
Yeah.
you know, the
And so the
tail.
one thing I'll add is that inflation is definitely showing signs from a raw material standpoint of topping out, but how quickly that transfers into the end user segment, the consumer segment, where consumers start to become the beneficiaries of lower inflation. To me, I think that's the critical part here. How quickly do you see this translate at the pump? How quickly do you see the give back from a food standpoint? You got to look at those core goods and how quickly you can see inflation come off. Look, you're likely to see non-discretionary goods show signs of inflationary easing up. People obviously don't need TVs, don't need discretion, certain discretionary goods in tough times. But the critical part here will be, okay, energy prices have come off in spot market, in the futures market. How quickly does that translate to the consumer? And as much as I've been critical of the Federal Reserve here, they've got a tall task ahead of trying to decipher all this, especially with the give back in interest rates now, on what's sustainable, what's transitory. Where I don't think there are any easy answers here in the next couple of months.
I'm just taking a quick look at the chart and kind of picking out some points. Um, if we are indeed moving lower, but today we had a lower high. I'm sorry, lower high, lower low. That's a turning point in a chart generally. Um, the target I see is taking us back down to the call it 575 in September. I'm talking September. Um, if this is just a blip on the radar, upside would be 700. At 700 on our way to 931. So, or we can go sideways. So I think that this is going to be an important week from a price standpoint to give us some direction. If the business continues to be good and mills are able to extend their order file and all of a sudden they start to reduce their production capacity due to summer shutdown kind of activity, we could see it continue higher. But if the prices don't move higher from here, chances are we're going to grind a little bit lower and go test those lows again.
Yeah, I think that's I agree, Mike. I think that's well said. And I think the one thing today shows, especially with kind of the positive close on Friday, being limit up at one point, how some of these other markets, extraneous events can really influence lumber on any given day.
Yeah, it's always the unknown. It's the everybody knows the knowns, and we're factoring those in. It's the unknowns that are going to come in and change things. But Greg, you always bring good information, especially about those ancillary markets, and they're showing us something. There's something in the tea leaves about crude right now. There's something in the tea leaves about copper. So we'll look forward to next Tuesday and see where we're at.
Yeah, I appreciate it. Good being back, and we'll see everybody next week. Thanks a lot, Mike.
All right, and any questions about the new contract, please let us know. We will help you out as much as we possibly can as far as trading some of those spreads and how some strategies you can move your position if you have one on.
Yep.
All right.
Thanks a lot, everybody. Take care.